Hello, and welcome to the Venue Coach Blueprint for Owners. I'm Kyle Labar. This podcast is all about helping you fill your wedding venue with more bookings, earn more from each one, and keep your customers happy for a long time. We'll also talk about some tough times and big lessons that I've learned along the way. Let's dive in together and make your venue the best spot for weddings. Hey everybody, welcome to another episode of the Venue Coach, and today is Financial Friday, so I'm going to talk about some things that we like to do for our venues, and specifically around how to decrease our expenses, and even more specifically, how to decrease our mortgage. And so this is one thing that it takes time before you can reevaluate and restructure debt. However, if were like us and you got an SBA loan with a variable rate and you got it before 2022 and now you're at 5% or 4% maybe, and now you're at 11%, yeah, that really sucks. And so let's not be victim to that, and let's take back some control over those finances. So one thing that you'll need to do, and this is from our own experience working with banks and going through the whole process quite a few times. So the thing that there's a couple of metrics that they care about. There's loan to value. So that's how much equity, how much value is in it, and how much are you borrowing against it. Now you should already be at like 25 or greater on that loan to value, so you should have 25% or more in equity. You'll need an appraisal. The bank will order that. They have to get it through their people, whatever. But you'll need an appraisal to get the new value if you've had it for a while, and that will help you. The other thing that factors in is you want to make sure that the appraisal is accounting for not just the property but also the business itself. So you have a book of business that's worth something. You have your contracts that are scheduled to be paid out over the coming months and year or greater than a year. And then the other piece is that they're looking for a debt service ratio. So they're looking at how viable is this business at paying back the loan that you're borrowing. So if you're at a high interest rate, obviously your current DSR is going to be low, but you're going to look at what will be after getting it to a lower rate. So for an example, if you had a $2 million loan for 25 years, which is typical with the SBA, you have an 11% interest rate, you're probably paying around $19,000 to $20,000 a month in interest. And combat that with like a 7%, which is what I'm starting to see in the commercial mortgage rates, and that's down to 14,000. So you go from 19 to 14, you're going to save $5,000 a month. So for some venues, that's one venue. That's one booking, sorry, not venue, but that's one booking every single month that you become more profitable by. And some of you, it might be a little bit less, it might be a third, but still, imagine getting one extra booking a month or getting one extra booking every quarter. And that's what it could mean for a lot of venues if you have that type of interest rate. And so just reducing it by 4% will get you that drop in overall debt load that you're having to pay out. And so now you go, like you automatically, if you can do this, then you get an automatic $60,000 added back to the profitability of the business every year that the interest rates otherwise would have stayed above 7%. And so it takes a little bit of time. You got to go through the process with the bank, and I know everybody who's gone through it probably feels the pain that I felt, where we just hate banks and we hate working with them, and it's such an ordeal, and it's a lot more than we think that it should be. However, it's the nature of the beast unless you're able to convince like a private lender or something like that. However, if you go to the bank, you present your financials, and as long as you're showing good numbers, right, either you're profitable or maybe you're a little bit like reporting on tax purposes, you're reporting a little bit of a loss from depreciation and from your interest expense and taxes, then that's that's fine. Um, it's not ideal if you're a little bit negative in terms of getting approved and that sort of thing. However, if you argue the case that, well, yeah, we reported a loss because of depreciation, the bank's going to add that back. So you want to make sure that you're not going negative because the business is actually there's something wrong with the business, but rather that it's because you had depreciation, you had interest payments on your mortgage, or maybe there's owner labor involved in that too. And so if you have those things, they can add those back and it will bring you back to a profitable range. So the number one thing is the bank wants to make sure that they're going to get theirs. They're going to get paid back and that you're going to be able to do that for the years to come. So that's the first one. And then the next one is they want to make sure that the business will support the value is actually there. So these are safety metrics that they put in place to protect themselves as they make this investment into your property. Ideally, the banks do not want to own these properties, right? That's what they're trying to avoid. They want to lend the money out so that they can get interest back. They don't want to actually own the properties because that means they have to foreclose and they have to put it up for auction and they got to sell it off because they don't know how to run a wedding venue. They don't. They don't want to. They don't. Their business is loaning money. So if you make it easier on them, it'll be easier on you to get approved. So I hope that this was helpful for you. If you found that it was, or if you'd like to learn more about like the process that we're going through, because we're actively, we're actively going through this right now to get our interest rates down. And so if you'd like to learn more about that or see a little bit more as far as that process goes, let me know. Drop a comment and I'd be happy to talk more about that. Otherwise, if you found this useful, please subscribe and stay tuned for the next one.